Your next reading is cost of capital, starting with question number 1. The optimal capital budget is the amount of capital determined by, let us first see a diagram that will explain the idea. As you can see, on the x-axis we have amount of new capital. On the y-axis we have cost or return. First consider this red curve. This is the marginal cost of capital. Every additional capital will cost you more. Every additional capital cost goes up, up, up and up, because the risk of the fund provider goes up. That's why the required rate goes up as well. So the marginal cost of capital is an upward sloping curve. Now look at this green one. Investment opportunity schedule, called IOS. Now let us try to make sense of this curve. Company will invest the first tranche of money where the return is the highest. Subsequent investments definitely will offer more returns, because company will try to invest as much funds as possible at the higher rate of returns. The remaining amount will then be distributed among those projects offering lower returns. Thereby, your investment opportunity schedule, if arranged in descending order with regard to internal rate of return, it will show a negatively sloping curve. Where these two curves intersect, the marginal cost of capital and your investment opportunity, downward sloping curve, when they intersect, this is your optimal capital budget. At this point, your cost and the expected benefit at a particular investment point, they're both same. This is the equilibrium point. So that is what you need to answer this question. The point of tangency, no tangency, just where these two curves intersect. Downward sloping marginal cost curve, no, marginal cost curve is upward sloping, we've just seen. Upward sloping marginal cost of capital intersects with the upward sloping investment opportunity schedule. Investment opportunity schedule has a negatively sloping curve. So these are totally other way around. So that means C must be the right answer. Upward sloping marginal cost of capital curve, where it intersects with the downward sloping investment opportunity schedule. That's where you have your capital, optimal capital budget, given with the option C. Next. The following information applies to a corporation. The company has 200 millions of equity, okay, 100 million of debt. The company recently issued bonds at 9%. The corporation tax rate is 30%. The company's beta is 1.125. What are we required to do? If the risk-free rate is 6% and the expected return on the market portfolio is 14%, RM, the company's after-tax weighted average cost of capital. Weighted average cost of capital. So we first need to determine the components cost of the capitals, KD, and cost of the common equity. We know the cost of debt is coupon, or if given the yield curve, ideally. But in this case, we have just been given this percentage, 9%, multiplied by the tax rate, 1 minus tax rate, because debt is taken as after interest. So 9% minus 1 minus 30%. So the cost of debt would be 0.7 times 9, that's 6.3. Cost of debt is 6.3 after tax. Cost of common equity. Can we apply beta? The capital asset pricing model. We have beta, we have RF, we have return on market. Yes, we can. Can we apply the dividend discount model? No, because these are the two models included in your syllabus. Dividend discount model and capital asset pricing model. So the given information dictates that we use capital asset pricing model, CAPM. So we need risk-free rate. What's the risk-free rate? That's 6% plus beta, that is 1.125, into return on the market, that is 14%, minus risk-free rate, that is given as 6%. Solving this all give you the cost of equity. 1.125 times the difference between 14 and 6. To this add 6 gives you a total of 15%. So your cost of common equity is 15%. So the next step, you need to calculate the weighted average cost of capital. Remember, I have already calculated after tax cost of debt. Please do not bring in the after tax factor here. 6.3 is already after tax. So what I will do, I will need to take the weightage of debt, that is 100 million out of the total 300 million fund. So 100 out of 300, this is the proportion of debt multiplied with the cost of debt, which is already after tax. No further computation needed. Plus cost of equity is 15%. And the proportion of equity is 200 out of 300. So if you simplify all of this, you will get your right answer. 1/3 times 6.3 plus 2/3 of 15. It gives you a total of 12.1. This is your weighted average cost of capital given in option E, A, and that's your right answer. Next. Eleanor Rice, CFA, is asked to determine the appropriate weighted average cost of capital for Samson Brick Company. Rice is provided with the following data. Debt outstanding, market value is 10 million. If book value is given of different components of capital and the market value is given, you should always take market value. Market value 10 million, common stock outstanding market value 30 million, marginal tax rate 40%, cost of common equity 12%, cost of debt 8%. Directly we can calculate the weighted average cost of capital. WACC is equal to proportion of debt 10 plus 30, 40. 10/40 is debt. Cost of debt is given as 8%. Here we can write here after tax element 1 minus tax rate, that is 40%. Plus proportion of equity, that is 30 out of 40, multiplied by the cost of equity given as 12%. All you need to do is just simplify and you will get your result. So 10/40 basically is 25%. 0.25 times 8 times 0.6 plus 0.75 times 12 gives me a final answer of 10.2. And 10.2 it is, C. Okay, question number 4, theoretical one. At a recent Haggerty Semiconductors Board of Directors meeting, Merle Haggerty was asked to discuss the topic of the company's weighted average cost of capital. At the meeting, Haggerty made the following statements about the company's WACC. Are these two statements correct or incorrect? Or which of these is correct or which of these is incorrect? Vice versa. Let's see. Statement 1. A company creates value by producing a higher return on its assets than the cost of financing those assets. It's common sense. Your cost of financing is 10%. Anything you earn above this will create value for the firm, will increase the shareholders' wealth. As such, the weighted average cost of capital is the cost of financing a firm's assets and can be viewed as the firm's opportunity cost of financing its assets. So you need to earn more than WACC, because weighted average cost of capital is the average cost of various sources of finance. So in order to create wealth, in order to create value, products should earn a return more than your WACC. It's a correct statement. Since the firm's weighted average cost of capital reflects the average risk of the projects that make up the firm, it is not appropriate for evaluating all new projects. Since weighted average cost of capital is an aggregate for the whole firm, it is not appropriate for evaluating all new projects. It should be adjusted upward for the projects with greater than average risk, absolutely makes sense, and downward for the projects with the less than average risk. Let's say our weighted average cost of capital is 10%. If you take on a new project that is risky, so the discount rate used for evaluating that project should be higher than 10, let's say 13%. Any project that has less risk than the current company's operations, so it should be discounted at a low rate, let's say maybe 7% or 8%. It is correct too. Both of these statements are correct. Both of these statements are correct, so that makes B to be the correct option. Here we go. BMP Limited has the following capital structure: 40% debt. This is the weightage of debt. You can write it as WD. I do not go for niceties. I just need the numbers and plug them in the right place and get your result. Speed and time. You do not have the time for niceties. 40% debt, 60% equity. The cost of equity is 16%. I will just label it as KCE, cost of common equity. It's before the tax. Its before tax cost of debt is 8%. And its corporate tax rate is 40%. BMP is considering between two mutually exclusive, mind this word, mutually exclusive projects that have the following cash flows. Project X, 100 million today, 50 in year 1, 30 year 2, 50 in year 3. Project Y, 150 outflow today, 50, 60 and 80 inflows in year 1, 2, 3 respectively. So what should we do? Which project should BPM choose? Of course, NPV. But for NPV, we need a discount rate. What to do? We have two different sources of finance, debt and equity. So it means we need to use WACC, weighted average cost of capital. Apply the formula straight away. Do not go for niceties. Save time. Debt is 40% of your total capital structure. And the cost of debt is given 8. Since it's pre-tax, you need to write 1 minus tax rate, that is 40%. Plus cost of equity. Equity represents 60% of your funding. Multiply this with 16% cost of equity and just do it in a single go. The way I'm going to do 40.4 times 0.8, 8% times 0.60 plus 60% of 16. That gives me 11.52. This is your weighted average cost of capital. And this is what you will use to discount these two projects. Let's write down the data for Project X. Project X requires cash flow at year 0 of 100 million. 100 million, enter, down arrow key. Then you have 50 million coming in the first year. Since the single payment, enter, down arrow key twice. 30, enter, down arrow key twice. And 50, enter, down arrow key twice. What you do then? Press NPV key. The system will require you to enter the discount rate, which you have just calculated using WACC, 11.52. Once done, enter, down arrow key and press CPT. You will get the discount rate. Do the same for Project Y. Cash flow to year 0. Outflow 150. Enter, single arrow key. Then you have 50, enter, double because it's a single amount, frequency is 1. Then 60, enter, double arrow key down, and 80, enter, down arrow key twice. Do the same thing, NPV, 11.52, enter, down arrow key and CPT. And that's how you do it. So for Project X, we have 100 million, negative, enter, down arrow key, 50, enter, down arrow key twice because of single cash flow, 30, enter, down arrow key twice. Then we have again 50, enter, down arrow key twice, press NPV, enter the discount rate 11.52, enter, down arrow key, press CPT, that's 5.0077 million. So Project X, 5 million. Let us calculate for Project Y as well. Project Y, 150 is your initial investment. 50, enter, double arrow key. 60, enter, down arrow key twice. 80, enter, down arrow key twice. Then you need to press NPV, press the rate 11.52, enter, down arrow key and CPT. This is 0.76. So NPV for the second project is very less. For this project, it was 5 million. Compared to this project's NPV, 0.76 million. So since they are mutually exclusive projects, so we will put our money where there is more NPV. So that definitely makes X to be a better choice. Project X, because its NPV is $5 million. That is your correct answer, B. This is a huge question. It's a huge question. The question of the day. It's a huge question. Will take maybe 10 to 15 minutes. It's a very big question. Okay, let's just extract the data and then do the working. Meredith Suresh, an analyst with Torch Electric, is evaluating two capital projects. Project 1 has an initial cost of $200,000 and is expected to produce cash flows of $55,000 per year for the next 8 years. Okay, Project 2 has an initial cost of $100,000 and it is expected to produce cash flows of $40,000 per year for the next 4 years. Okay, both projects should be financed at Torch's weighted average cost of capital used for discounting. Torch current stock price is 40 and next year's expected dividend is 1.80. Dividend discount model, this is D1. The firm's growth rate is 5%, that is G. The current tax rate is 30%. The pre-tax cost of debt is 8%. The Torch has a target capital structure TCS of 50% equity, 50% debt. If Torch takes on either project, it will need to be financed with externally generated equity, which has flotation cost of 4%. So the money will come from issuance of equity and the flotation cost is 4%. Suresh is aware that there are two common methods for accounting for flotation cost. The first method, commonly used in textbooks, in your CMA as well, that's what we do in CMA, of course, is to incorporate the flotation cost directly into the cost of equity, cost of debt, cost of preferred stock. We've done it in your section B, Corporate Finance CMA Part 1, Part 2. The second approach, which you haven't studied in your CMA, is more accurate. The second and more correct approach is to subtract the dollar value of the flotation cost from the project's NPV. In fact, you consider it as your initial outflow, just like this 100,000 in case of second project, 200,000 in case of first project. The flotation cost is embedded or is included in this initial outflow. That's the difference. Okay. If Suresh uses the cost of equity adjustment approach to account for flotation costs rather than the correct cash flow, will the NPV for each project be overstated or understated? What the question says, if Suresh uses the cost of equity adjustment, the first method which we use in CMA Part 2, the cost of equity adjustment approach to account for flotation cost rather than the correct cash flow adjustment approach, will the NPV for each project will be overstated or understated? We need to apply this approach in two different ways. First, the incorrect approach. I shouldn't be saying incorrect approach. The right word should be the textbook approach or the CMA approach, right? And then the correct approach. Let us do these workings side by side. We have the related information. And as I said, it's a big question, huge question, will take time. Be prepared. We'll explain you many things at many different levels. Let's apply first the textbook approach. Under the textbook approach or the CMA approach, we will consider this flotation cost as a part of cost of common equity and cost of debt. Let us lay down the working. I'm sure you have the information in you might have noted it down, or you should note it down. We need tax rate, we need the current market price, we need the dividend next, we need the growth rate, and we need the percentage proportion of debt and equity, that is 50-50. That's all. I think that's all. We'll come back if we need anything else. Right, now first we need to calculate the cost of common equity under the conventional method. So it's going to be D1 upon the current market price minus the flotation cost plus growth rate. This is the cost of equity. How do we calculate the cost of debt? Cost of debt is equal to the coupon given 8% into 1 minus tax rate. Right. Cost of debt will be 8% into 0.7. That will be 5.6%. What was next dividend? Dividend 1, 1.80. So write 1.80. Current share price is 40. Flotation cost is 4%. Current share price is 40. Flotation cost is 4%. So there are two ways. Either you write 40 here minus 4% of 40, or you can simply do $40 times 96%. This will deduct the flotation cost directly from the current share price. And to this add the growth rate, that is 5%. So it's 1.8 divided by 96% of 40. Long question. So be patient, gentlemen. Be patient. To this add 5%. That gives you 9.6875%. This is the cost of equity using dividend discount model, where the flotation cost has been embedded as a part of cost of capital. Next step is we need to calculate the weighted average cost of capital, WACC. 50% of the cost of debt, that is 5.6. Already after tax, I don't need to do it again. And 50% of 9.6875. If I calculate the weighted average cost of capital 50-50. It will give me 7.64375%. This is the discount rate, quite extended one, it didn't round it off. This is the discount rate you will use in discounting. Okay, both the projects, we have the information. Let's just have a look again. First project, 200,000 initial outflow, 55,000 yearly inflows for next 8 years. Then for the second one, 100,000 outflow and then 40,000 inflow for the next 4 years. So keep this information. It's not the incorrect approach, it's the textbook approach. So first, we have 200,000 outflow and there are 55,000 inflow in each of the next 8 years. Right? Second project, 100,000 outflow and there are 40,000 inflows in the next 4 years. And I'm sure you know what to do. You will use your financial calculator. You will write for the first project CF0 minus 200,000. Enter down arrow key 55,000. Enter down arrow key. Since there are 8 such cash flows, frequencies 8, enter down arrow key. Then you simply press NPV. Enter the discount rate 7.64375. Enter down arrow key and press CPT. You do the same thing for this one, but just the frequency is 4, initial outflow is 100, and annual cash flows are 55. So let us first do this for the first project. 200,000 negative, enter down arrow key. Then we have $55,000, enter down arrow key. There are 8 such inflows, enter down arrow key. NPV, enter the interest rate, that was 7.64. You don't need to be that accurate. I'm putting all these 5 places after decimal. 375. Enter down arrow key, CPT. It's 120,383. For the first project, NPV, I'm going to write at some suitable place. It is 120,283. Please do not forget, this is the approach. This textbook approach is the one that this gentleman, whoever his name is, Meredith Suresh, he has used this approach, the textbook approach. For the second one, let's do the second one as well. Initial outflow, 100,000 negative. Enter down arrow key. Then there are 4 inflows of 40,000, enter down arrow key, 4, enter down arrow key, all entered, press NPV. Interest rate is 7.64375. Enter down arrow key, CPT. It's 33,542. 33,542. So this is the textbook approach. 120,283. Now we will do the right approach, the correct method. And what we will do, the flotation cost, instead of embedding the flotation cost in the cost of equity, we will consider the flotation cost as a part of your initial outflow in project 1 as well as in project 2. For this, you need to go back. These are the 2 outflows of project 1 and 2 respectively. 4% is the flotation cost. How much would it make? 4% of flotation cost. Let's do the working right here. We just need these 2 numbers and rest of it must be cleared. For project 1, NPV was 120,383. NPV. For project 2, it was 33,542. Now, what we will do, we will first calculate individual cost of common equity and cost of debt. This time, we will simply take the discount, the dividend upon the current market price plus growth rate. No adjustment of flotation cost, just like the way we did previously. Just these numbers to calculate the cost of equity. Cost of debt would be the same because there is no flotation cost for cost of debt. So it's the same. 8% into 1 minus tax rate, that gives you 5.6%. And for this, Dividend is 1.8. Next dividend divided by current market price 40. To this you simply add the growth rate, that is 5%. So it should be equal to 1.8 divided by 40 plus 9.5. Straight rounded number, it's 9.5. So 5.6 is after tax cost of debt. 9.5 is the cost of equity. So what would be your weighted average cost of capital now? 50% of 9.5 plus 50% of 5.6. If you calculate this, this will give you 7.55. So this is the discount rate you will use, 7.55%. We haven't yet calculated the flotation cost. All right. It says the Torch has a target capital structure of 50% of equity and 50% of debt, and they want to maintain this structure. If Torch takes on either project, it will need to be financed with external generated equity, which has flotation cost of 4%. In the first project, total project size is $200,000. 50% of this would come from equity, and the flotation cost is 4%. So that makes 100,000 times 4, that is $4,000. So it means the flotation cost for the first project would be $4,000. For the second project, simply 100,000 times 50% times 4%, that will be just $2,000. So these are the two additional cash outflows. It means $200,000 outflow, and this 4,000 must be embedded in it. It means the total outflow for project 1 will be 204,000. That was the difference. Second one will be 102,000. Rest of the cash flows are the same. What were the cash flows? If I remember correctly, it was 55,000 for first project for the 8 years period, and for the second project, it was 40,000 for the next 4 periods. And using this, let us calculate the NPV and see how do they tie up. I will do it directly on the calculator. Project 1, 204,000, negative, enter, down arrow key. Then you have 55,000, enter, down arrow key. The frequency is 8, enter, down arrow key. NPV, the rate you will use is 7.55, enter, down arrow key, CPT. It's 117,535. Let's write it down. 117,534.9, or approximately 5. Next. For the second project, outflow is 102,000. Negative, enter, down arrow key. Then you have the cash flows $40,000 for the next 4 years. Enter, down arrow key, 4, enter, down arrow key. NPV, the rate is 11.55, 7.55. 7.55. Enter, down arrow key, press CPT. It is 31,823. 31,823. So now we have the final conclusion. Now we have the final result. Not the incorrect approach. This is the textbook approach used by Mr. Suresh, and this is what he should have done. So resultantly, his NPV in both cases is overstated. Project 1 is overstated by slightly 3,000 around, and project 2 is also slightly overstated by $2,000. So both project 1 and project 2 are overstated. That was required. It said, if Suresh uses the cost of equity adjustment approach, the textbook approach, to account for the flotation cost rather than the correct cash flow adjustment approach, will the NPV of each project be overstated or understated? So as we have seen that under his approach, he has overstated both of these NPVs, and that gives B to be the correct option. Overstated, overstated. So he has done it quite an extended way. It's a good question. Makes you understand many concepts at many different levels. Weightage of cost of, calculating of cost of common equity, cost of debt, their weightages, and then calculating the NPVs under two different approaches. A good question indeed. Next. A company's outstanding 20-year N20 annual pays 6% coupon. 6% coupon bond are selling for $894. This is the current market price, PV. At a tax rate of 40%, the company's after-tax cost of debt is closest to. we need to calculate the yield after tax. How do we do it? First of all, 20 is the number of payments, or 20 periods. The face value 894 is the current market price, PV is 894. Remember, whenever you're calculating valuation of bonds or yield for bonds, you need to consider the current market price as negative. The face value or the future value of the bond is 1000. 894 means the par is bond 1000. If it had it been 98, it means the par is $100. If it's 894, it means the par is $1000. So $1000 is FV, PV is negative 894, and what else? What is the interest rate? Interest is paid, remember gentlemen, ladies, interest is paid at coupon. Interest is paid at the stated rate, coupon rate, but discounting is done at the yield. Remember, that's an important point to remember. Most of the students make this mistake. So the payment on $1000 par value bond at 6% is 60. So your payment PMT is 60. So what you will do, you use your financial calculator, enter the period, the current market price, the face value of the bond, payments, and you will simply compute your interest or yield, and that should give you the result. Let us do it using the calculator. 20 is N. Okay. 894 negative, it's the present value, current market price. 1000 is the face value, the future value of the bond. 60 is the interest payment, PMT, and you just need to compute the interest. 7.0006. 7.0006, and that is C. But since it's yes, this needs to be given after tax. So yes, 7.0006 is your result, but this is the pre-tax cost of debt. Since the question explicitly says after tax cost of debt, so it's a simple thing. What you will do, after tax cost of debt is 7.00, whatever it is, multiplied by 1 minus tax rate, that is 40%. So it's going to be 7 times 0.6, 4.2. So that makes A to be the correct option, and A it is. Next, the Garden and Home store recently issued preferred stock paying $2 annual dividends. The price of its preferred stock is 20. This is the market price of the preferred stock. This is the dividend you pay. The after tax or before tax, preferred stock, they are not affected. The cost of preferred stock is not affected by tax, because dividend is not tax deductible. Dividend on preferred stock or on common stock, it is not tax deductible. That's why there is no adjustment of tax for cost of preferred stock or cost of common equity. So cost of preferred stock is simply dividend upon the market price. Dividend is $2. The current market price is 20. That's 0.1 times 100 gives you in percentage 10%. No adjustment for tax. Interest is tax deductible. That's why we have to take interest after tax, just like in the previous case. So that makes A to be the correct option. 8 is next. A firm has 4 million in outstanding bonds that mature in 4 years with a fixed rate of 7.5%. Assume annual payments. The bonds trade at a price of 98, which means the face value of the bond will be 100. Just like in the previous case, it was 894. That means the face value was $1,000. So in this case, face value is 100. Current market price is 98. Okay, what else do we need? The firm marginal tax rate is 35%. Using the bond yield plus method, what is the firm's cost of equity risk, assuming an add-on of 4%? We have many ways to incorporate risk in our cost of equity calculation. One of these is cost of common equity can be adjusted for equity risk factor. Equity risk factor. Plus, to this we add pre-tax cost of debt. Pre-tax cost of debt. This is one of the ways to calculate the cost of equity. So he has given you this 4%, that is the equity risk factor. We just need to calculate the pre-tax cost of debt. ERF is given. You can simply add a 4%. We need to calculate pre-tax cost of debt. For this, we have the data. We have the period of bonds 4N, interest 7.5, 100 times 7.5, 100 is the par value, times 7.5 is $7.5, that is your PMT. Then the face value is 100, FV, and the current market price is 98, that is PV. All you need to do is just press CPT and it will give you the interest or yield, and there we go. Let's do it. 4N, 7.5 is PMT, 100 FV, 98 negative is the current market price PV. Just press CPT and this sign, it gives you 8.1053. Just add this number here, 8.1053. It gives you a total of 12.1053. I have this bad habit of writing more digits after the decimal point. Anyways, so it's 12.11. That makes C to be the correct option. And C it is. Next. Which of the following statements is least accurate? Mind the word least accurate regarding the marginal cost of capital's role in determining the net present value of a project. Least accurate. The project for which the present value of after-tax cash inflows is greater than the present value of after-tax cash outflows should be undertaken by the firm. Absolutely correct. Present value of inflows should be greater than the present value of outflows. That's ideally the situation where you will have a positive NPV. It's correct. We are looking for the one that is incorrect. It's true. The NPV of the potential projects of above average risk should be calculated using the marginal cost of capital for the firm. This is inappropriate. Your weighted average cost of capital is your existing. It is according to your existing risk of the firm. If you take on a project that is riskier than the current operations, then your discount rate should be more than your weighted average cost of capital. If you take on a project that offers less risk than the current risks, then the discount rate can be less than the weighted average cost of capital. But this statement B is totally in opposite direction. If you are taking above average risk, your cost of capital should be increased. You need to increase your discount rate. You can't use the current weighted average cost of capital. Right? So this was inaccurate. Let's see option C as well. When using firm's marginal cost of capital to evaluate a specific project, there is an implicit assumption that the capital structure of the firm will remain at the target capital structure. That's one of the assumptions we used in solving the previous question. The target capital structure 50-50, 60-40, 30-70, it stays the same. It's true as well. So B was the one that is least accurate, in fact, incorrect statement. Next. Nippon Post Corporation NPC, a Japanese software development firm, has a capital structure that is comprised 60% common equity and 40% debt. In order to finance several capital projects, NPC will raise $1.6 million by issuing common equity and debt in proportion to its current capital structure, that is 60-40. The debt will be issued at par 9% coupon, and flotation cost on the equity would be 3.5%. Right? NPC's common stock is currently trading at 21.4 and its last dividend was 1.8 and is expected to grow at 7%. This is your growth rate. The company's tax rate is 40%. NPC's weighted average cost of capital based on the cost of new capital is closest to. We need to calculate the cost of both of these and then we need to calculate the weightage. First of all, calculate the cost of debt. Cost of debt is simply the coupon because this is what we have been given. Ideally, if you have been given yield, take the yield rate, not the coupon. But since this is what I've been given, debt issued at 9%, 9% times 1 minus tax rate will give you 5.4%. Then for cost of equity, the cost of common equity, we will only be using the dividend discount model, else the CAPM data is not given. So the formula is D1, the next dividend, upon the current share price plus the growth rate. Dividend given is 1.8. That was the last dividend. This is not D1. This is not D1. This is D0. How do we convert D0 into D1? By simply multiplying D0 with the growth rate, that is 7%. So it's just simply multiply the current dividend with 1.07. It will give you the next dividend. So D is 1.8 times 1.07. 1.926 divided by the current share price, that is 21.4. To this add 7%, simplify the result, 1.926 divided by 21.4, and to this add 7% gives you 16%. The question that you should ask me, why I have not considered the flotation cost. Since we have just agreed that flotation cost is considered as an outflow at year 0. That is the correct approach. It is not adjusted in the cost of equity or cost of debt through flotation cost, just we did in the previous question. So that's why I've just ignored this. I've just plugged in the numbers, ignoring the flotation cost. And this is your cost of debt, cost of equity. Calculation of WACC is simple now. Proportionate is 60% equity at the rate of 16%. Plus 40% debt at the rate of 5.4%. And just simplify and you get your result. 0.6 times 16 plus 0.4 times 5.6 gives you total 11.84, and that is option B. B it is. Hedge Corporation's target capital structure is 40% debt, 50% common stock, and 10% preferred stock. 3 components. Preferred stock, common stock, and debt. Right, what exactly do we need? Weighted average cost of capital. Okay, so we have been given the weight. Let us calculate the cost of the individual components. The company's bond have a nominal yield of 7%. Take this to be the cost of debt after tax. KD is equal to 7% times 1 minus tax rate, that is 40%. Do whatever you can do right there and then. Instead of just reading the question first and then doing the computationals, you will simply waste time. 7 times 0.6 gives you 4.2. This is the after-tax cost of debt. Next, the company's preferred stock sells for 40, pays an annual dividend of 4 upon 40 times 100 gives 10%. This is your cost of preferred stock, KPS. Khalas, don't overspend time on things that we can do there and then. The company's common stock sells for 25 a share and is expected to pay a dividend of 2, and this is the next dividend. That is expected dividend means the next dividend. It's not D0, so we don't need to increase it by the growth rate. The dividend is expected to grow at the rate of 7%, and then that's all. Cost of common equity is equal to next dividend upon the current market price. Express this in percentage, and to this simply add your growth rate, and there you go. 2 by 25 times 100 plus 7 gives me the cost of common equity, 15%. There we go. Weighted average cost of capital. Your debt is 40%. The cost of debt is 4.2. Cost of preferred stock is 10%, and the cost of preferred stock is 10% as well. Weightage is 10%, cost is 10%. Okay, the cost of common equity, we've just calculated 15%, weightage is 50. So 50% times 15. And that's all. 0.4 times 4.2, point times 10, plus 0.5 times 15 gives me a total 10.18. 10.18%, that is B. Right? Solve whatever you can there and then. Instead of reading the whole question and then going back and doing the computation, you will only waste time. This is what you would have learned through your CMA certification. Again, information is given. What do we need? CAPM, the dividend discount model. If the appropriate risk premium relative bond yield is 40, what turns equity cost of capital using the dividend discount model. We just need to use the dividend discount model, which is cost of common equity is equal to D0 or D1 increased by the growth rate divided by the current market price plus growth. We need these things and nothing else. I don't need anything related to bonds. 7% growth rate, yes, that's what I need. The last dividend was paid 0.93, that was D naught. 0.93 to be increased by the growth rate. Current market price 16. Khalas, I need nothing else. Plug these numbers and get your result. 0.93 times 1.07 divided by 16 expressed in percentage. Add 7 to it, gives you 13.2. There we go. B. B it is. Save time. Look at the data and extract what exactly is needed. A firm is planning a 25 million expansion project. The project will be financed with a 10 million funding in debt and 15 million in equity. Okay. 10, 15, that's the proportion. 10 by 25, 15 by 25. Equal to the company's current capital structure. The before tax required return on debt is 10% and equity 15%. You have what you need. Convert this before tax cost of debt into after tax by just multiplying 10 with the tax rate, 1 minus tax rate, 1 minus that. That is 6.5 straight away. That's 6.5. After tax cost of debt is 6.5. Cost of equity is 15. You need to calculate weighted average cost of capital. Instead of just converting these amounts into percentage, you can do it directly. 10 is needed from debt out of total 25. 10 by 25 multiplied by the cost of debt 6.5. 15 would come from equity out of the total funding needed 25 times 15. Khalas, simple. No need to convert in percentages. Do your working and take as much time, little time as possible. Plus 15 times 25 times 15 gives you a total of 11.6. Tuck, there we go. And here B is the right answer. B it is. Next, Genoa Corporation pays 40% of its earnings out of its dividend. That is the payout ratio. This is called the dividend payout ratio. The return on equity is 15%. Last year's earnings were $5 per share. That was EPS. And the dividend was just paid to the shareholders. The current price of the share is 42. The firm's tax rate is 30%. The cost of common equity. The only model you can use here is the dividend discount model, because we don't have the beta related, so CAPM cannot be applied. So you need to look at the information carefully. The information given will dictate you which method you will use to calculate the cost of equity. So we don't have growth rate. We don't have growth rate, but we have what we need to calculate the growth rate. Sustainable growth rate is equal to return on equity multiplied by 1 minus dividend payout ratio. Return on equity 15% into 1 minus dividend payout ratio is 40%. That solves half of your problem. 15% times 60 gives you 9%. That is your sustainable growth rate. We'll use it as G in our dividend discount model. Dividend discount model is cost of common equity is equal to, we have been given the current dividend. We need to grow it with a certain rate. So D naught times 1 plus G upon the current share price plus growth rate. There we go. What is D naught? 40% of the earning is paid as dividend. 40% of $5 gives you $2. That's the current dividend that we have just paid. Multiplied with growth rate, we have just calculated, it's 9.1. So 1 plus 9%, 1.09. What's the current share price? Current share price is 42. Plus the growth rate, 9%. There you go. 2 into 1.09 times upon 42. Convert in percentage to this, add 9% gives you 14.19%. 14.1919 and rounded off gives you 14.2. Simple. A is your answer. Next question. Cullen Casket Company is considering a project that requires $175,000 cash outlay. That's an initial investment and is expected to produce cash flows of $65,000 per year for the next 4 years. Cullen tax rate is 40% and the before tax cost of debt is 9%. The current share price of Cullen is $32 per share and is expected. The expected dividend next year is $1.5 per share. Cullen expected growth rate is 5%, that is G. Cullen finances the project with 70% newly issued equity and 30% debt. And the flotation cost for equity is 4.5%. What is the dollar amount of the flotation cost attributable to the project? And that the NPV of the project you need to calculate, assuming that the flotation costs are accounted for correctly. There are two ways to treating the flotation cost. The first one is to consider the flotation cost as an initial outflow at the start of the project. And second is to embed or incorporate the flotation cost within the cost of capital. So this is the correct approach, treating your flotation cost as an initial outflow, as a part of your initial investment. So we need $175,000. 70% of this would come from equity and 30% would come from debt. 70% of this amount becomes $122,500. And 4.5% of this amount is your flotation cost. If you calculate 4.5% of 122,500, it is $5,512.5, which is approximately 5,513. So either A or B. If you just want to guess, either A or B would be the right answer. We have to calculate the net present value also. For net present value calculation, we need to find first the cost of capital. There are just two sources of finance, debt at 9% and the cost of equity is to be calculated. So let us first find the cost of equity using the dividend discount model. Using dividend discount model, cost of equity is equal to next dividend which we are going to pay, that is $1.5. Divided with the current share price, that is 32. To this just simply add the growth rate that has been given as 5% and simplify the result. 1.5 upon 32, express it in percentage. To this add 5%, they give you cost of capital, cost of equity, $9.69, 9.69%. This is your cost of equity, common equity. Next, you need to calculate the cost of debt. That's very simple. Take simply the cost of debt given, convert it into after tax by multiplying it with 1 minus what was the tax rate, 40%. It will give you 9 times 6. Now you can directly embed the numbers in your weighted average cost of capital, and that would be the basis to calculate your NPV. So we know weighted average cost of capital in this case is we have 70% equity at the rate of 9.69 and we have remaining 30% of debt, which is equal to 9 times 0.6, 5.4. So 9.69 times 70% plus 5.4 times 30 gives you 8.403. 8.403%. This is your weighted average cost of capital, which you will use to calculate the NPV of the project. The project requires an initial investment of $175,000 plus treating this flotation cost correctly means this 5513 must be considered as an initial outflow, which means the initial outflow would be $175,000 less both of these, negative 175 and negative 5513. That's what you need in total. It's going to be 175, 5513, that is 175,000 plus 5513, that is 180,513. That's your initial investment. You need to calculate NPV. You will use your financial calculator. I will just lay down the keys that you will punch and get your NPV. So first what you will write cash flow to your 0, that is negative 180,513. Then you have these $65,000 inflows every year for the next 4 years. So you will write $65,000, punch in 65, enter, down arrow key. Since they are occurring 4 times, the frequency is 4, you will enter 4, enter, down arrow key, press NPV key, press this discount rate 8.403, enter, down arrow key, press CPT. You will get your net present value, which will be 32,872 point something. That will definitely be option A, right? So simply use these keys, enter the data, and you will get your result. So that makes A to be the correct option. Next, in order to more accurately estimate the cost of equity for a company situated in a developing market, when you say developing market, means China, Russia, Pakistan, India, developing economies. So we need to make some adjustment in the cost of equity. In order to make more accurately estimate the cost of equity for a company situated in a developing market, an analyst should do what? The recommended approach is to simply take the market risk premium in that particular country, add country risk premium. Add country risk premium to the market risk premium, when using the capital asset pricing model. That is the suggested approach. We don't take risk-free rate and we don't add country risk premium to risk-free rate. Neither do we take the sovereign debt, yield on sovereign debt, because we're talking about equities. The basis on equities, market risk premium plus country risk premium. That will be the rate you will use for your computations. So that makes A to be the correct option. Next. Farwell Radar Technologies has 5 years, 7.5 notes outstanding that trade at a yield to maturity of 6.8. When you have been given the coupon and yield for weighted average computations, you should consider the yield rate. The company's marginal tax rate is 35%. Farwell plans to issue new 5 years notes to finance an expansion. New. So what would be the cost of debt or the new issue? Now, this is interesting. If the expected yield on this new note, if it's available, you will take that. You will use that. But since we have not been given any information, so what you will do, you will have to use the yield on existing debt, right? Yield to maturity on existing debt. This is used as a close approximation. If the yield to maturity is not given for the new issue, you will take this 6.8 as the cost of debt for your new issue. So that makes 6.8 is given, but we have to convert it into after tax, multiplied with 1 minus tax rate is 35%. So 6.8 into 65% should give you what? Let me calculate. 6.8 times 65 gives you 4.42. That's A. 4.4. The cost of preferred stock is equal to the preferred stock dividend divided by what? We know cost of preferred stock is dividend divided by the market price. It's also called the dividend yield for preferred stock. Dividend upon market price is the dividend yield for the preferred stock. So that makes stock dividend upon the market price B. B to be the correct option, and B it is. Next. Arlington Machinery currently has asset on its balance sheet of $300 million that is financed with 70% equity and 30% debt. 70 equity, 30 debt. The executive management team of Arlington is considering a major expansion that would require raising additional capital. Jeffrey Marion, an analyst with Arlington Machinery, has put together the following schedule for the cost of debt and equity. There are two statements given, and we have been given different ranges of debt and equity when there will be a breaking point, when the cost of debt and equity will jump. Normally, when you take debt upon equity and return or cost on this side, you have a consistent cost of equity to a certain level. Whenever the additional cost is additional debt or additional equity is taken, there is a breaking point that will make this a little jump in your cost of capital. This sudden jump at certain point of additional funding is called breaking point or the break point. So in presentation to Arlington's executive management team, these are the break points of different levels at debt and equity given here. So in presentation to Arlington's executive management team, Marion takes or makes the following statements. What we need, which of these statements are correct? First, if we maintain our target capital structure 70 equity and 30 debt, the break point at which our cost of equity will increase to 9% is approximately $286 million in new capital. Okay, now we existing funding or existing assets on our balance sheet are $300 million. Out of that, 70% has come from equity, 30% has come from debt. That means $90 million from debt and $210 million from equity. Now, if you just look at this, 210 falls within this. Let us see if the funding reaches up to 200 million of equity. You know the formula, 200 million equity divided by the proportion of equity within the overall composition of your capital. 200 divided by 0.7 gives you 285.71. 285.71, yes. If the funding needs are 285.71, out of which 70% will come from equity, there will be a break point. So if we maintain our target capital structure of 70% equity, 30% debt, the break point at which our cost of equity will increase to 9% is approximately 286 in the new capital, out of which 70% will come from equity. So that is correct statement. Next, if we want to finance total assets of 600 million, out of which 300 million are already available, and as I said, we need 210 million from equity and remaining 90 million will come from debt. our weighted average cost of capital for the additional financing need will be 7.56. Now, when you need 210 million of equity, so this would be the relevant cost for equity. When you need 90 million of new debt, it falls here. So it means the relevant cost of debt is 4.2, cost of equity 9, since it has to be taken after tax and it is given after tax, no further working is needed. You can directly calculate the weighted average cost of capital. 70% of your funding has come at the rate of 9% cost and the 30% remaining has come at the cost of 4.2. If you do the whole computation, let me do it for you. 9.7 plus 0.3 times 4.2, it gives you 7.56, the exact number that has been given in statement 2. So your weighted average cost of capital in case of a total funding of 600 million, out of which 300 million has already been invested in the current composition of our capital employed, the remaining 300 million will take the cost of capital to 7.56. That makes statement to be the correct statement as well. So that makes B to be the correct option. Statement 1 is correct, statement 2 is correct as well. B. A publicly traded company has a beta of 1.2, a debt to equity ratio of 1.5 and return on equity 8.1% and a marginal tax rate of 40%. The unlevered beta for this company is closest to. First, let me give you the formula. How do we calculate the unlevered beta? Sometimes called asset beta or unlevered beta. It's equal to beta levered or equity beta 1 upon 1 plus 1 minus tax rate into debt upon equity. That's the formula that relates your unlevered beta or asset beta with the equity or the levered beta. This is called pure play. Pure play. Why? What's pure? Pure play is a company that is involved in a specific market niche, a particular product, a particular activity, a particular process that is so unique, a single one product that a company specializes in. Let's say a company specializing in making customized accounting software. For example, that's just the example that came to my mind. Accounting software, bespoke accounting software for the firms, right? Just one specific line of service, nothing else. No Android or iPhone or etc. Accounting application for clients. Now, I need to invest in a project that is similar to this software development. Now, my current beta, my equity beta is different. What I will have to do, I will have to take the beta of this firm, use it as a basis. I will select this as a comparable base because I will use this company's beta and will unlever it and use it for my computation to calculate the specific beta for the project related to software development. So the first step is select the comparable. I have the software development company. The next step, estimate the comparable beta, which is given here. You need to unlever it using this formula, and then you can lever it again, keeping in your debt to equity ratio. So first step is to unlever this beta, the closest competitor of the company that you have selected. The comparable beta would be most appropriate rather than saying it competitive or a comparator. So you will convert into unlevered comparable beta, and then you will convert the unlevered beta into your levered beta using your own specific debt to equity ratio. This is just an introduction. There are multiple questions of this type and I will explain the idea. So a publicly traded company has a beta of 1.2, debt to equity ratio of 1.5, return on equity 8.1, marginal tax rate 40. We need to calculate unlevered beta. This is the unlevered beta. Consider this is the beta for the software development company, levered beta. We'll have to convert into unlevered one and then you will use it for your own specific project for which you want to calculate the cost of capital. So beta is given 1.2, levered beta for this software development company that we have selected, comparable beta. 1 upon 1 plus 1 minus tax rate has been given as 40%. Debt to equity of this software development company, it has been given as 1.5. I'm going to solve this all for you first. 1.5 times 0.60 plus 1 and take reciprocal of this number and then multiply it with 1.2. It gives me 0.6315. 6315. This is unlevered or asset beta, specific for this software development company. Done. You have got your result. The next step, which hasn't yet been covered in this question, I will leverage this beta according to my debt to equity ratio. Let's say my debt to equity ratio, let's say 30%. My debt to equity ratio is 30%. Debt upon equity is 30%. So just the formula I've used. The formula I used was beta unlevered or asset beta is equal to levered beta into 1 over 1 plus 1 minus tax rate into debt upon equity. If you simply take this denominator and multiply it to the other side, you will get the levered beta, and this new arrangement would be unlevered beta or asset beta into 1 plus 1 minus tax into debt upon equity. This is the last step. What I'm going to do, I'm using this unlevered beta and converting it into levered beta that I will use in my project evaluation, the beta for my specific project specific risk. So unlevered beta, we just calculated 0.632, not needed. We got our result. A is the result. This is going one step ahead. 0.632, 1 plus 1 minus tax rate, and we have just assumed that my leverage debt to equity is 30%, and you can just solve this one. 0.3 times 60 plus 1 times 0.632 gives me 0.745. This is the beta that I will use for calculating the cost of, for discounting purpose for this specific project involving software development. There will be multiple questions of this nature, maybe somewhere around after question 22 or 25 or 26 onwards. So that's what we call the pure play. Select the comparable software development company, estimate the comparables beta. We took this 1.2, unlevered it. That's the unlevered one, 0.632. And then we levered it according to our own debt to equity ratio. This is what we will use in our weighted average cost of capital computations. Here we go. Tony Costa, operations manager of Biochem Incorporated, is exploring a proposed product line expansion. Costa explains that he estimates the beta for the project by seeking out a publicly traded firm that is engaged exclusively in the same business as the proposed Biochem product line expansion, just like the software company we're discussing. The beta of the proposed project is estimated from the beta of that firm after appropriate adjustments for capital structure, that's debt or equity. This method is called pure play. Look no further, we have just done it, pure play. Next, which of the following statements about the marginal cost of capital is most accurate? MCC is the cost of the last dollar obtained from bondholders. Why bondholders? When you say cost of capital, it involves equity, it involves preferred stock. Why just bondholders only? MCC falls as more and more capital is raised in a given period. No. If you take debt to equity on the x-axis, your cost of capital on the vertical axis, when the debt to equity is 0, when there is no debt, pure equity firm, even then the curve moves in this direction, indicating that every additional dollar you raise from the market, the cost would be higher. If you add debt to it, the debt, of course, is cheaper. It attracts tax savings. Interest is a tax deductible expense. So when you add some part of debt to it, cost falls. And after a certain point, which is the optimum point, the cost starts going up. Means additional debt will be expensive. A certain point will be reached where the cost of capital would be lower, but additional debt will cost you more. Resultantly, the cost will go up. So saying that MCC falls as more and more capital is raised is given period wrong. MCC goes up. Marginal cost of capital for every additional dollar raised goes up. Weighted average cost of capital for every additional dollar raised goes up. That's the case in most of the cases. So this is wrong. Then what? The break point that we just saw a little while earlier on the MCC curve occurs when one of the components in the weighted average cost of capital changes in cost. Could be debt, equity, or preferred stock. This was the previous question. So this is the break point. 50 million for debt, cost jumps from 4 to 4.2. 50 to 100, the cost jumps from 4.2 to 4.5. Same is true for equity. As additional equity is raised, additional equity will cost you more. Next, yes. Stolzenberg Technologies has target capital structure of 60% equity, 40% debt. The schedule of financing costs for Stolzenberg is shown in the table below. Within this bracket of debt, cost is 4.5. Additional debt will cost more. That's what we were discussing. Additional funding in debt and equity will be costlier. Marginal cost of capital rises as additional dollars are obtained in funding. 400 to 599, 5.5. 0 to 299, 7.5. And as you can see, it's jumping. Stolzenberg Technology has breakpoints for raising additional financing at what point? Let's first consider 500 million. If it's 500 million, remember the equity and debt proportion is 60-40. So for 500, it means 60% should come from equity. 500 60% means 300 million should come from equity, this one. And the 200 million remaining should come from debt. Right? So it means for 500 million, the cost would be this. When it is raised to 1 million, 1 million's 40% should come from debt. That is 400. See, there is a jump. There is a jump at 500 million as well as 1,000 million. So 400 million jump or breakpoint will be for debt. And even a single component changes in cost, it's a breakpoint. Maybe that if you just calculate here, you need 600 million from equity, which falls within this 8.5. But since debt is jumping at 200 as well as 400, the component cost changes. Even the equity has remained the same. 8.5 in the first part and even 8.5 in the second one. But since the debt has jumped at both points from 200 and 400 both, so it means at both these financing needs, debt will cause the change in your weighted average cost of capital. So there are breakpoints at both of these funding needs. A is the right answer. Next, assume a firm uses constant weighted average cost to select investment projects rather than adjusting the projects for risk. If you do not adjust your projects for risk, the reason is your weighted average cost of capital needs adjustment upwards for risky projects. If the projects are less riskier, you can adjust it downwards. So this firm has made a mistake. They did not adjust the WACC. Assume a firm uses constant WACC for all the projects, riskier or not riskier. So what would be the likely result? Let us first lay down how we can reach the question or how we can tackle the question. WACC as a hurdle rate that we need to cross in order to generate positive NPV. If it is kept as constant, so either it will be too high for some projects or it will be too low. If you are using constant WACC, either it will be too high or too low. If it is too high, it will reject many profitable projects. If it is too high, if you have kept WACC too high, some profitable projects which are good, but since you have a higher hurdle rate, they might be rejected. If it is kept too low, some projects which are bad, they might be selected. That's the problem. If WACC is not adjusted for risk, it's either too high or too low. If it's too high, some good projects might be rejected. If it is too low, some dirty, bad projects might be selected. That could be the problem. So you might reject some profitable projects because it is too high. And you might select some unprofitable projects because you have kept it too low. Right? So that could be the problem. So WACC needs adjustment, requires adjustments for different riskiness of the project. So that makes A to be the correct option. Next. Which of the following is most accurate regarding the component costs and component weights in firm's weighted average cost of capital? First, taxes reduce the cost of debt. So far, correct. For firms in countries in which interest payments are tax deductible, almost I think everywhere, as far as I know, where I have worked, interest is a tax allowable expense. Interest is tax deductible. You get benefit on tax. So tax reduces cost of debt. That's the reason we have this formula for calculating cost of debt. Coupon or effective rate multiplied by 1 minus tax rate. This is the effective cost of debt. It is some part of the interest is saved by tax. So the cost of debt, that's why it's low. So we need to look no further. A is the right answer, and A it is. Affluence Incorporated is considering whether to expand its recreational sports division by embarking on a new project. Affluence capital structure consists of 75% debt and 25% equity. And this project definitely involves levering and unlevering. So let us first calculate debt to equity ratio. Debt to equity. Debt is 75, quite high. 3 times of your equity. So it's 3. Debt to equity is 3. Okay. And the marginal tax rate is 30%. Aspire Brands is a publicly traded firm that specializes in recreational sports products. Recreational sports products. Aspire has a debt to equity ratio of 1.7, beta of 0.8 and marginal tax rate of 35%. That's pure play. Do we have the slide here? This is exactly what we discussed a little while earlier. Select the comparable. We have Aspire Brands. It's a specialized firm in recreational sports product. That's the exact line of products we are moving in. So we'll estimate this comparables beta, unlever it and use it for our own projects evaluation. So it's a good question. So this is the comparable firm we have selected. Aspire Brands is a publicly traded firm. This is beta, this is debt to equity, and this is the tax rate relevant for this firm. What do we need? Using the pure play method with Aspire as a comparable firm, the project beta Affluence should use to calculate the cost of equity capital closest to now. First of all, you will unlever. You will calculate the beta, asset beta or unlevered beta. It's equal to the comparables beta over 1 plus 1 minus tax rate, that is 35%, multiplied by debt to equity, that is given here as 1.7. Now let me solve this. 1.7 times 0.65 plus 1 and take reciprocal of this is 0. And multiply with 0.8 gives you 0.380. This is unlevered beta or asset beta, specific to this recreational sports business. Now this unlevered beta needs to be levered according to our debt to equity. You need to use the reverse of this formula. The beta levered is equal to unlevered beta 0.380 multiplied by 1 plus 1 minus tax rate. For me, what's the tax rate? For me, it's 30%. This is my tax bracket. Multiplied by my leverage. What is my leverage? It's 3. So what I have done, I've calculated the unlevered or asset beta for recreational sports business. This is the unlevered beta, 0.380. Now I will lever it again, considering my debt to equity ratio, my capital structure. So it's going to be 3 times 0.70 plus 1 times 0.138 gives me 1.178. 1.178, and that's approximately 1.18. That makes C to be the correct option, and C it is. A company primarily engaged in the production of cement has the following characteristics: beta 0.8, market value of debt is 180, market value of equity 540, effective tax rate 25, marginal tax rate 35. The asset beta that should be used by company considering entering into cement production, what would be asset beta? Asset beta or unlevered beta is equal to beta for this firm times 1 upon 1 plus 1 minus tax rate, marginal tax rate for 180, that is debt upon equity 540, and you just need to simplify this. 180 divided by 540 times 0.66 plus 1 reciprocal multiplied by 0.8 gives you 0.6557. 0.6557, that is approximately 0.656. That makes C to be the correct option. Remember, when you need to unlever or lever, you need to use the marginal tax rate. Effective tax rate is computed for accounting purposes. For cost of capital purposes, we use marginal tax rate, remember. So that gives you C to be the correct option. Next, To finance a proposed project, Yongham Corporation would need to issue 25 million in equity. Yongham would receive 23 million in net proceeds. So what you will not receive is $2 million. And why have you received less? This is the flotation cost. When analyzing the project, the analyst at Yongham should do what? Not consider the flotation cost because it is a sunk cost. This is not the right approach. We have two approaches. One is called the bookish approach, which we use in CMA. And other is the correct approach. What is the correct approach? Consider this 2 million as initial outflow at year 0 for project evaluations. So add 2 million flotation cost to the project's initial cash outflows. That's the correct approach. And that's what you should use in your CFA NPV computations. So that makes B to be the correct option. A company has the following capital structure. We need to calculate the weighted average cost of capital. Target weightings 30% debt, 20% preferred stock, 50% common stock, and tax rate 35%. Okay. So we need the cost of debt, preferred stock, and common stock. Also, good question. The firm can issue 1,000 face value, 7% semi-annual coupon debt with 15 years maturity for a price of 1047.46. This will help us calculate the cost of debt. A preferred stock that pays dividend of 2.8 has a value of $35. So cost of preferred stock, which I label as KPS, is equal to 2.8 upon 35. And it will give me 2.8 upon 35 times 100. That's 8%. The company's growth rate is 6%. That's G. The company's shares have a value 40 at a dividend in year 0 that has just been paid. That's the dividend now. So the formula that we'll use is cost of common equity, the dividend discount model, current dividend times 1 plus G upon current share price plus growth rate. So we have D naught, that's 3, times 1 plus growth rate, that is 6%, upon current share price, that's 40, and to this simply add the growth rate, that is 6%. Let me calculate 3 times 1.06 upon 40, convert this into percentage, to this add 6 gives you 13.95. This is your cost of equity, 13.95. 8% cost of preferred stock. The issue here is the computation of the cost of debt. Use your financial calculator. I won't. That always messes things up and just things go haywire. So I'm just going to lay you down the working and I will just simply let you know what the result would be. So what you will do, this is your face value. You will enter 1000 FV. Since a semi-annual one, so the interest payments would be $70 a year. Since semi-annual payments mean you will receive 35, or if you have invested, you will receive. If you have issued, you will have to pay $35 the payment, $70. 7% of 1,000 means 70 for annual payments. Since it has to be converted on semi-annual basis, so it's 35. Half of 70, 35. So that is your PMT. Years to be doubled, interest to be halved. So year to be doubled, that's 15 years, means 15 times to 30 periods, 30 N. Right now the present value, as I said, is to be given in negative in your financial calculator, negative 1047.46, and this is your PV. Once all done, you will compute your yield. It will give you 3.25. This 3.25 needs to be converted on annual basis by multiplying it with 2. That's now 6.5%. Now, we have all components. 6.5% is the cost of debt, cost of preferred stock, cost of common equity, and we have the weightages also, and we have the tax also. So we can just simply calculate and get our result. Weighted average cost of capital is equal to debt is 30%. Tax rate has been given as, we always make mistake in tax rates, 35%. So it's going to be 6.5 times 35% less 1, that's 4.225. Plus 20% preferred stock, the cost of preferred stock is 8%. Plus cost of equity 13.95%, and it is a total of 50% of your total funding. So 0.3 times 4.225, 0.2 times 8 plus 0.5 times 13.95 gives you 9.8425. 9.8425, since we need to give the result up to 2 decimal places. 9.84. That is your right answer, B. See, long working. Somehow we got it there. Which of the following statements is most accurate regarding the firm's cost of preferred shares? A firm cost of preferred share is approximately equal to the market price of the firm's debt as a percentage of the market price as common. This is incorrect. Cost of debt is not an cost of debt is after tax basis. KD is R times 1 minus tax rate. So it can't be equal to the preferred stock rate. So approximately equal to the market price of the firm's debt as a percentage of the market price of its common share. Wrong. The dividend yield, what is dividend yield only? Just forget about it, what the statement is. Dividend yield is the dividend upon market price, whether they are preferred stock or the common stock. So dividend yield is dividend upon market price. This is the cost of preferred stock. He's just tested the formula. So dividend yield on the firm's newly issued preferred stock, dividend upon market price. Perfect. Need to look no further. B is the right answer. B it is. Next. A firm is considering a $200,000 project that will last 3 years and has a falling financial data. Just a minute. So this is your initial requirement of funds. The project will last for 3 years and it has the following financial data. Annual after-tax cash flows are expected to be $90,000. This is your initial investment. And this is your annual recurring cash flow for 3 years. Target debt to equity ratio is 0.4. Cost of equity 14. Cost of debt 7. Rate tax 34%. What is needed? Determine the project's payback period and net present value. When the cash flows are consistent, 90, 90, 90, the payback period can simply be calculated by dividing your initial investment with annual cash flows. 200,000 divided by 90,000 will give you 200,000 divided by 90, 2.22 years straight away. Simple as that. So if you just want to guess, either A or B would be the right answer. So either A or B. So to refine our working, you need to calculate NPV as well. So what do we have? We have initial investment, cash flow to year 0 is equal to $200,000. And I'm sure you know what to do. Enter down arrow key. You have to receive $90,000 every year and it will repeat for the next 3 years. So it's going to be $90,000. Enter down arrow key. Enter 3 as a frequency. Enter down arrow key. And then you do press NPV. System will ask you to enter the discount rate. We don't have the discount rate yet. That's what is needed. We need to calculate the weighted average cost of capital. And for this, we have everything what we need. We have debt to equity. We have cost of equity. We have cost of debt. And we can solve it directly here. Okay. Weighted average cost of capital is equal to debt to equity is 0.4. What does it mean? It means debt is 0.4 or 40% of equity. If debt is 0.4 of equity, what is equity? Equity is 1. If debt is 0.4 of equity, equity has to be 1. Then what are the total fundings? 1.4. If total funding is 1.4, then what is the debt's proportion? 1 upon 1.4 or 0.4 upon 1.4. What is the proportion relevant to equity? 1 upon 1.4. So what I've done simply, 0.4 is debt is 0.4 times of equity. It means equity is 1. Debt is 0.4. Total funding 1.4. Debt is 0.4 times of 1.4 and equity is 1 part of 1.4. So 0.4 by 1.4, 1 by 1.4. There are other ways to calculate. You can calculate percentage if you want to. Keep your working as simple as possible. So your debt proportion is 0.4 upon 1.4 and the cost of debt has been given as 7%. You need to convert it into after tax basis, that is 1 minus 34%. Plus equity is 1 out of 1.4 and just cost of equity is simply 14%. Let me calculate this one. 0.4 upon 1.4 times 7% times 66 gives me 1.32 plus 1 upon 1.4 times 14% gives me 10. So it means your weighted average cost of capital is 11.32%, and that's what you will use for calculating your NPV. So when you press NPV, the system will ask to enter the rate. You will enter the rate 11.32, press enter sign, down arrow key, press CPT, and you should get this number as your NPV. That makes A to be your correct option. See, saving a lot of time when you're not using the calculator. You have got the idea. I've shared the videos how to use calculator for calculating the bond valuation and for NPV computations. Next, a firm has 3 million in outstanding 10 years bonds with a fixed rate of 8%. Assume annual payments. The bond trade at a price of 92, current price PV, 100 par, that's FV. The firm's marginal tax rate 35%. What is the after-tax component cost of debt to be used in weighted average computation? So 10 is N minus 92, the current PV, that is PV. Face value, the redemption value, the future value, that is $100 positive. Payments, it's 8%, $100 bond, that's $8 every year, 8 PMT. What you need, simply press CPT, you will get your rate 9.26%. Have you been given the tax rate? If tax rate is given, you have to bring it back after tax basis. Apparently you will jump at option C, but that will be wrong. We need after tax component cost of debt. After, the emphasis on after, so that's why KD is 9.26 times 1 minus tax rate, that is 35%. So it's going to be 9.26 times 0.65, that's 6.019, which is approximately 6.02. That makes A to be the correct option. Next, a company is planning 50 million expansion. Expansion is to be financed by selling 20 million in new debt. 20 is what percentage of the funding? 40%. Common equity is 30 million. 30 million is what percent of the total funding? 60%. So it's a 40-60 game. Debt is 40% of the total funding needs and equity is 60%. The before tax required return on debt is 9% and the required return on equity 14%. So this 9% must be converted into after tax basis, and we have been given tax as 40% tax bracket 1 minus 40%. So that's 9 times 0.6, that is 5.4%. 5.4% is the after tax cost of debt. Equity will be taken as it is. There is no impact of taxes on the cost of equity. So next step is to calculate weighted average cost of capital. 0.4 times 5.4 plus 0.6 times 14 gives you 10.56, and 10.56 if rounded off gives you 10.6, and that gives you A to be the correct option, and A it should be. A financial analyst is estimating the effect on the cost of capital for a company for a decrease in the marginal tax rate. Decrease in marginal tax rate. How would it affect the cost of capital? Of course, when the tax rate goes down, the effective cost of debt will go up. It will affect the cost of debt. If the tax rate goes up, you will, like, let me give you an example, what I want to say. Let's say tax rate right now is 30%. Your bond issued at a coupon or effective rate of, let's say 6%. What is the after tax cost of debt? 6% into 1 minus 30%, right? That is 6 times 0.70. That is 4.2%. Let's say tax rate now falls to or goes up to 70%. Now look at this. Cost of debt, 6% into 1 minus 70%. 6 times 0.3, just 1.8%. See? So the tax rate goes up, the effective cost of debt goes down. What has happened here? A financial analyst is estimating the effect on the cost of capital for a company of decrease in the marginal tax rate. The company is financed with debt and common equity. A decrease in the firm's marginal tax rate would do what? Decrease the cost of capital? No. There is a decrease in tax rate, so it will increase the cost of capital. Increase the cost of capital because of higher after-tax cost of debt. After-tax cost of debt is fine, but increase or decrease in tax rate doesn't affect equity. You have to remove equity from both of these options. Debt increase or decrease affects the cost. Tax increase or decrease affects the cost of debt, not equity. So since tax rate has fallen, from 70% to 30%. So the cost of debt will go up from 1.8 to 4.2. So it will increase the cost of capital because of higher after-tax cost of debt. That is the right option, C. Next, a firm has $100 in equity and 300 in debt. 100 in equity, 300 in debt. If you want to convert in percentage, that's 25 and 75%. Equity is 25%, debt is 75%. The firm recently issued bonds at the market required rate of return of 9%. The firm's beta is 1.125. The risk-free rate is 6%, and the expected return on market is 14%. Assume the firm is at their optimal capital structure, and the firm's tax rate is 40%. What is the firm's weighted average cost of capital? Okay, we have been given the cost of debt as 9%, which we will need to convert into after-tax basis. Let's do it right here. Cost of debt is equal to 9% into 1 minus tax rate. Tax rate is 40%. So 9 into 0.6, well, 5.4. This is the cost of debt. For equity, we have been given the ingredients. We have been given the risk-free rate, beta, return on the market, and that's what you need for the CAPM. Capital asset pricing model. Cost of equity is equal to risk-free rate plus beta times return on the market and risk-free rate. Risk-free rate is 6%, beta is 1.125, expected return on the market is 14, risk-free rate is 6%. If you just simplify this all, 14 less 6 times 1.125 plus 6 gives you 15%. That's all, done. Equity is to overall 25% of your funding, 100 and 300, and debt is 75%. So these are the weightages. We have the costs also. We can calculate the weighted average cost of capital. WACC now is equal to 25 times of 15 and 75% or 75% times 5.4 after tax cost of debt. So let's do it. 0.25 times 15, 0.75 times 5.4 gives you 7.8. This is your weighted average cost of capital. That matches perfectly with your option C, and C it is. Julius Incorporated is in 40% marginal tax bracket. The firm can raise as much capital as needed in the bond market at a cost of 10%. The preferred stock has a fixed dividend of $4. The price for preferred stock is 31.5. Very simple question. The after-tax cost of debt and the preferred stock would be cost of debt is equal to the rate times 1 minus tax rate, that's 40%. It will be straight away 6%, which either C or A. Cost of preferred stock is equal to dividend, that's $4 upon the current market price. 4 by 31.5, that's 12.69. And 12.69 means approximately 12.7. That makes C to be the correct option. Speed, gentlemen, speed and accuracy. If a central bank actions cause the risk-free rate to increase, if RF goes up, what is the most likely change to the cost of debt and the cost of equity capital? Since we just saw that the expected return or the cost of equity is RF times beta whatever, since when RF goes up, the cost of equity goes up. When the risk-free rate goes up, your effective rate on the interest on the bonds go up. So risk-free rate, if it increases, the cost of equity and cost of debt, they will both go up. Remember, whenever risk-free rate goes up, cost of debt definitely goes up. Risk-free rate goes up, as per the CAPM, the cost of common equity will also go up. So both will increase. That makes B to be the correct option. Accel Corporation earned $3 per share and paid dividend of 2.4. This is earning per share. This is the dividend per share paid on its common stock last year, D0. The dividend just paid. Its common stock is trading at $40, that is P0. Accel is expected to have a return on equity 15%, ROE, an effective tax rate of 34%, and to maintain its historical payout ratio going forward. In estimating Accel's after-tax cost of capital, an analyst estimate of Accel's cost of common equity would be closest to, for the purpose of calculating after-tax cost of capital. Gentlemen, we have been given, we can't use CAPM, capital asset pricing model. We haven't been given beta or return on the market. So we are left with only this version, D0, dividend discount model, P0 plus G. Do we have D0? Yes. Do we have P0? Yes. We don't have G. Do we have some numbers that can help us calculate G? Sustainable growth rate, SGR, yes. Return on equity into 1 minus dividend payout ratio. Return on equity has been given as 15%. 1 minus dividend payout ratio. Dividend has been paid 2.4 out of the total earning $3 per share. 2.4 is what percentage of 3? That is 80%. Payout ratio has been 80%. Most of the earnings have been given out as dividends, so it means retention ratio, sometimes also called ROE into retention ratio. 20% has been retained, 80% has been given out as a dividend. So retention ratio times 15 times 0.2 is 3%. This is the growth rate. Plug it in and you should get your result. 2.4, that's your current dividend. Growth rate is 3%. 1 plus 3% upon current share price, that is 40. To this add growth rate. Let me calculate all of this. 1.03 times 2.4 upon 40 times 100. 6.18. To this add 3% gives you 9.18. And 9.18 is approximately 9.2. That makes B to be your correct option. A company has the following data associated with it: a target capital structure of 10% preferred stock, common stock, and debt. What do we need? Outstanding 20 years annual bonds paying 6% coupon, selling at 894. This will help us calculate the cost of debt. Common stock selling for 45, expected to grow at 8%. Current dividend, expected dividend. This is D1. Next dividend is D1 as per the dividend discount model. $2 dividend 1 year from today, D1. Their 5% and then their 5% 100 par preferred stock currently sells for $90. This will help us calculate cost of preferred stock. Tax rate is given, and a good question, a very good one. Many things are needed to be computed before you calculate the weighted average cost of capital. Let us first go with the debt. 20 years debt, N is 20. Next, future value, face value, that is 1,000. 894 means 1,000 is the face value. Payments, 6% of 1,000, 60. Present value, it's 894. Remember always to use negative sign with this. And then compute CPT-I, interest yield, that's 7%. Cost of debt is calculated. It has to be taken after tax basis. Don't forget that. Next we can calculate cost of common equity, cost of equity. We have been given the next dividend $2 and the current share price is 45 and the growth rate is 8%. So let's do it. 2 upon 45 times 100 plus 8 gives you 12.44. That's your cost of 12.44% cost of equity. Cost of preferred stock, $90 is the market price. The dividend, 5% of 1,100, that is $5. 5 by 90 times 100, that gives you 5.55. We have got everything. Cost of preferred stock, cost of equity, 12.44, and cost of debt. And we need to convert it into after-tax basis. Next step is to calculate the weighted average cost of capital. Your preferred stock first is 10%. Cost of preferred stock is 5.55 plus next is 50% common stock, 50% of 12.44, and the debt is 40%. 40% of debt, and don't forget this 7% has to be written in after tax form and tax rate is 40%. Let me do the computation. 0.10, 0.1 times 5.55 plus 0.5 times 12.44 plus 0.5, 0.4 times 7 times 0.6 gives me 8.455. 8.455 is approximately 8.5, and that gives you B to be the correct option. Now, as you can see, debt capital, preferred stock, weighted average cost of capital, most accurate way to account for flotation cost when issuing new equity. Done many times. So there are so many questions of similar nature. It'll be just a waste of time to do these questions repeatedly. We have done almost every type of question that can be tested in cost of capital. So I'm not going to waste any further time. And I'm going to just stop further recording. You can try these questions yourselves, and I'm sure if you have seen the first 40 questions, you will find these questions easy. Repetition, 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 and repetition, nothing else.